How the banking system actually works. Fractional reserve banking. Ever wonder what happens to your money after you deposit it in a bank? Here's a spoiler, it's not just sitting in a vault. In fact, the bank is allowed to lend out most of it, and that's how the whole system runs. What is fractional reserve banking? The US banking system runs on something called fractional reserve banking. It means banks are only required to keep a fraction of your money in reserve, and they lend out the rest. So if you deposit $1,000, your bank might only keep $100 on hand and lend out the other $900. That $900 gets deposited somewhere else, and that bank lends out 90% of it again. This cycle repeats, and your original $1,000 creates up to $9,000 in the economy. Why does this exist? Why do we use this system? Because it stimulates economic activity. Banks lend to people who buy homes, start businesses, or go to college. That drives growth. The Federal Reserve encourages this system because it helps expand the money supply, but it comes with risks. The risks they don't tell you. The obvious problem? What if everyone wants their money at the same time? That's called a bank run, and it's why the FDIC insures your deposits up to $250,000 per account. But fractional reserve banking also amplifies debt in the system. It means new money is created not by printing, but by lending. More loans, more debt, more money in circulation. This works fine until people stop paying those loans back. Here's what you need to take away. Your bank isn't just a storage locker, it's a money factory. The system is based on trust, stability, and the assumption that not everyone will need cash at once. Understanding this helps you make smarter decisions about savings, interest rates, and even investments. If you're keeping all your money in a bank thinking it's 100% safe, you're only seeing half the picture. Want to really master how money works behind the scenes? Follow for more in-depth finance breakdowns explained simply.